What is up, you guys? Q here from Hyperstocks. Thank you so much for checking in again. This is chapter 4 of your advanced stock trading course. In this chapter, we're going to start really diving into the important things that you have to pay attention to in the stock market. Why do stocks move? And we're going to more importantly move on to market psychology. Market psychology is a phenomena that drives the markets. Although it is a numbers place, there's numbers all around us. It's ratios when it comes to stock market. Market psychology is going to be the more important thing to understand as you're looking at charts. Look at charts in a psychological perspective and why they're moving, and try to understand how human behavior is driving these charts. Charts will move because buyers are buying and then sellers are selling. When buyers are outweighing the sellers, obviously we move up. When sellers are outweighing the buyers, obviously the stock is going to move down. Throughout their moves up and down, these buyers and these sellers are going to hit something called support and resistance points. Support and resistance points are lines that you're drawing across charts, and they're going to be at specific levels. For example, if a stock gets rejected at $80 and it begins to move back down, that will be a resistance point that got formed, not because of some kind of magical force out there or some number out there. It's just simply because people were not willing to pay more than $80 for that stock at that specific time, therefore making a resistance at $80. Start understanding the stock market from that perspective and not the perspective of pure numbers, because charts will tell you one thing, but humans were gifted with this ability to reason and understand why things are happening. And the reason why things are happening on the stock market is all because of the human interaction that we're having with it. And once you start understanding that, you'll start seeing human behavior and human patterns rather than just chart patterns, which is not something that will typically work all the time, because you need to understand both sides of the spectrum in order for you to figure out what's going on. Market psychology is also something that can drive markets for as long as years. And even though markets can be overvalued, market psychology can still drive markets to a level that's unseen or unforeseen. And that's simply because if there's a lot of buyers, people want to get in. And if people are getting in, they're not usually paying attention to the numbers. After a while, because there are so many buyers involved, people just think that it's an up and up game. And that's what creates bubbles, and that's what bursts bubbles as well. The same way that analysts and every single broker out there will start projecting crazy numbers for stocks when things are rallying, those same analysts are going to turn around and start decreasing their projections on these stocks when things start to sell off. And that's just because psychologically humans are going to move in herds. The idea is you want to beat the herd, and you don't want to hold too long when the herd actually starts to get moved the other way, because that's going to start and that's where fear and greed will come in. When people get too greedy and they hold too long, they start losing money. So understand that about your market psychology too. Why do stocks move? So stocks are going to move because of news, and that's not because the news event itself, and that's just because how people reacted to that news. That's what made the stock move. Specific patterns. Patterns only work because we all know them. So the more obvious the pattern, the more likely it's going to work. Don't try to force patterns when patterns are not there just because you have your own bias. Patterns will work because a lot of people are looking at the stock and they're recognizing that this may be something called a double top pattern. We're going to talk about patterns in the later chapters. Patterns are very important to know when you're looking at charts, because they're going to make or break your trading. If you recognize patterns in the market, and you'll start recognizing patterns more and more as you learn more and more stock trading, then you're going to be successful at it. But the combination of market psychology and patterns are going to be the key and golden key for you to make money. Earnings reports also move stocks. So if a stock has an earnings report and they blow their numbers out of the water and they're doing fantastic and their projections are high, that's also going to move the stock market. Major company announcements. So if there's a big CEO change to somebody that Wall Street loves, perhaps that's going to move the market in a positive way. Geopolitical tensions. So if there are tensions around the world, between war, between a shortage of any sort, black swan events like the COVID-19 pandemic that we all got to see. We all got to see how the stock market reacted to the COVID-19 pandemic. At first it crashed, and then the Federal Reserve policy came and rescued the market and actually doubled it by the end of the time that they were done putting money into it. So all of these things are going to move the market, and you're going to find out in your lifetime and in my lifetime that more things will start to come up that move the market. And naturally, as humans grow more and as we develop new technologies, we develop new things, there are going to be things that move the market. in different ways. When it comes to the news, something that to pay attention to that's very important is going to be economic updates. You want to pay attention to job reports, to gross domestic product. Is our country's GDP growing positively, or is it growing negatively? If it's positive, then generally our economy is in expansion mode, and we're looking good as an economy. If we're starting to go down in our GDP, however, then our economy is in recession mode. And if we're in a recession mode, that means things typically go down, consumer spending goes down. And if we're in a recession, the stock market will likely go down too. The stock market and the economy, they're two different things. The stock market doesn't point to a recession, but a recession may cause a stock market sell-off. Any fear of a recession, people are going to unload their assets and they're going to convert back to cash. They're going to spend less. Companies are going to make less, therefore hurting their bottom line. And if their bottom line is hurt, that means their stock goes down too. So these are things that you need to pay attention to in the stock market. You want to be up to date with your economic updates and everything like that. For this specific update, I like to look for investopedia.com. Investopedia.com. Here, I'll spell it out for you guys. Investopedia.com. These guys, they answer all my finance, economic questions, stock trading questions. Fantastic website. A ton of research behind their work. I trust them fully. This is not an ad for them or whatsoever. This is just a website that's always been there for me throughout the questions that I've had in my career. And they also have weekly updates. They tell you exactly what's going to happen in the week ahead, anything important to pay attention to. So definitely the website to pay attention to. I check it out every single Sunday is my routine. I look at Investopedia and I see what's happening in the week ahead. They give you a summary of what happened in the week previously, and they give you a projection of the week ahead. They don't give you numbers to pay attention to or anything in terms of stock levels. That's what we're going to teach you here. But they will tell you important events that are taking place economically and in the news. Major company headlines, something to pay attention to, of course. If there's insider buying and selling in the stock, I'm going to tell you one thing. Sometimes the insiders get it right and sometimes they don't. Nobody in the world knows what the stock market is going to do, whether it's going to go up, down, or sideways. But sometimes insiders know things that we don't know, therefore they sell the stock. But a lot of times you'd be surprised that they will sell the stock and next week the stock goes up, and they end up missing out on millions of dollars. But they had a notion that the stock was going to go down, or maybe they just sold because they were buying property somewhere or something. So don't be so quick to trust the news. Something that I need you to understand is the news is not your friend. They're not on your side. They're not going to give you stock picks. If they tell you that Michael Burry shorted Tesla and Tesla goes down for the first hour, it may skyrocket the next. Michael Burry doesn't know what's going to happen in the stock market either. If you're not familiar with who that is, he's somebody who called the Big Short. He's somebody who called the 2008 crash and ended up making a lot of money off of it. But it doesn't mean that he's going to get it right every time. It doesn't mean that you need to trust everything right away when it comes to the news. Just take everything with a grain of salt. That's the best way to put it. Whatever the news is telling you, make sure you do more research. Don't jump in so quickly. Don't be quick to react to headlines. If the stock market moves up for the first 10 seconds of the news, then perhaps the first 10 seconds were a bunch of people that were reacting with haste, and then next thing you know, it's selling off completely because the news wasn't that good. Also, something to pay attention to when it comes to the news, and something that's important to understand, is the news doesn't often hit right away. So if there is really amazing positive news for a company, the company doesn't need to necessarily react right away. The company's stock may take the next 3-4 weeks to slowly start moving up and building itself up. So if you want to trade solid headlines, make sure that there's actual factual information, because a lot of the times the news is also just trying to drive their own agenda. But if the company does something that's actually great and they're going to be making a lot of money from this, then you need to pay attention to that stock in the weeks ahead, not just the day of. Another thing to pay attention to is sometimes the news is already priced in. So say, for example, right now there's fears that the Federal Reserve is going to be raising interest rates in 3 months. The stock market, because the stock market doesn't like higher interest rates. It'll naturally start coming down during times of high interest rates. Maybe up until the meeting in which they raise interest rates, we may sell off until that meeting. and then the day of the meeting, when things become official, the stock market may reverse. The reason this happens is because the stock market doesn't like uncertainty, it likes facts. And even though facts sometimes can be bad, or they may have a poor impact on the stock market, as long as we have the facts and not uncertainty, that's when the stock market will move back into a positive territory. So just facts are what drive market movements to end sometimes during times of uncertainty. So just keep that in mind when you're trading. Political headlines obviously are going to impact the news. The best approach to this, and we're going to get to sectors in the final part of this chapter, political headlines, you will start understanding what moves with what. For example, right now, the best example that I can give, in 2022, we have the Russia and Ukraine tensions. And Russia is a major supplier of oil. And if Russia is a major supplier of oil, and now we have a blockage of their oil into the United States, naturally oil companies in America are going to start charging more. Their bottom lines are going to increase because the price of barrel goes up. And so naturally they'll start making more money. So to deduct, this is where your reasoning will come into play, to deduct that, hey, if we're going to have an oil war or a shortage of oil because oil is no longer coming from Russia, now I need to shift my attention to oil companies. So you'll start deducting which headlines will drive what. So, if retail is now flying and consumers are spending a ton in retail, you can see the numbers on a monthly basis. You can see the retail reports. Then perhaps it's time to pay attention to your Targets and your Walmarts. Just some examples of what headlines to pay attention to, and what sectors to pay attention to when it comes to reacting to these headlines. Earnings reports, they happen every fiscal quarter. So every time a quarter ends in the stock market, companies will start having earnings reports. Earnings reports are going to typically happen before or after the stock market hours. So a company may report before the bell or after the bell. And the reaction that happens from the earnings reports is always random. So there's no way to predict if the stock is going to go up or down. We're going to give you guys all the tools for you to recognize patterns and what could happen next, but there's no way to predict what's going to happen in to a stock in an earnings report. The reason why that is because during an earnings report, you're going to get the CEO and the CFO, which is the chief financial officer, to speak. And if these guys are going to give projections, they're going to give plans, they're going to give advancements to their stockholders, and if they just say one wrong word, it may drive the stock down. So nobody knows what these guys are going to say apart from themselves and probably the team around them. So my advice is, unless you're doing something called a lotto call and you're just taking a very high risk play, which we're going to talk about those a little bit, don't play earnings. That's going to be my advice. And if you do play earnings, play them very small. You don't need to spend a lot of money. You sometimes if a stock, for example, if Netflix drops 25% on their earnings, which is something that happened this year, if you had put $200, you would have made about $4,000. So even if you play earnings, you don't need to risk that much. So don't bet the farm just trying to be a millionaire overnight. Take them slowly. If you do play earnings because you have a feeling that Target is going to miss earnings severely due to slowing retail sales, then perhaps a very small bet would hurt. But just understand that the stock will react completely randomly. Why do stocks move? Another reason is overall market health, economic tension with other countries. If you're trading major markets, and if you're trading, things like SPY, Triple Q, which is the technology index, if you're trading stocks like Tesla, Apple, Facebook, overall market health is going to be the primary driver of the overall direction these stocks are going to go. If the overall market direction right now is up and everything is moving in a bullish manner, that's probably because we're in a state of low economic tension, no geopolitical tension, and things are kind of cool in the economy right now. Companies are reporting what they're supposed to report. So just always keep that in mind. the headline doesn't necessarily need to relate to the company you're trading for it to impact the entire sector. Technology makes up technology makes up pretty much, I believe, 2/5 of the overall market weight. And so, if technology is the primary weight in the market and there's a lot of headlines that are hurting technology, then the entire market is going to go down because technology is hurting. So, just understand where the overall market health lies. And as we go through these chapters and as you get your own experience in, you're going to start getting a sense of what's happening in the overall market. And that goes back to paying attention to the economic updates on a weekly basis. And this is why all these things tie into one another. Trends. So that goes back to overall market health. Long-term trends, short-term trends. Are you looking at things fundamentally or from a technical analysis standpoint? What's the difference? Fundamental analysis is looking at a company's bottom line. You're looking at their financial sheets, you're looking at their balance sheets, and I'm going to show you guys a quick synopsis of how to figure out where a company stands financially. This will help you tremendously during times when markets are selling off from a bubble, and you're gonna be able to recognize which companies were completely inflated and they need to correct further. And you're going to be able to find that out through fundamentals, which is something that we're going to go over. I know this is a technical analysis standpoint, but it's important. I think it's very important for people to understand fundamentals of companies, because if you want to be successful during an up and a down market, you need to understand which companies are going to sell off the most when things are looking bad for the fundamental companies. Because right now, perfect example, in 2022, we're seeing a major bubble burst, from a correction that was caused for 2 years between 2020 and 2021. We saw markets rally, and companies that were making little to nothing compared to their valuations, they were just hurting fundamentally, and they were targets to play things like short positions and puts on them, so betting against them to make money on the way that they're selling off. Because if you want to be successful in the market and want to be a successful trader, you have to know how to play both up and down markets, and that's going to come through understanding the fundamentals and technical analysis, which is things like candlestick charts, which are things like patterns and indicators, oscillators, something that we're going to teach you all about. Finally, last but not least, the last part of this chapter is going to be sectors. So sectors I'm not gonna go through all of these. I'm gonna actually attach these to a PDF for you, just so you understand which sectors exist in the market. You have the communications sector, and these are the industries that are within it. You have consumer discretionary. These are the 11 industries that are in it, and so on and so forth. Again, this is going to be attached into a PDF for you. That way you can see these. You remember when we went over the ThinkorSwim platform together, and I told you that I break down my watch lists into sectors. So I have, for example, I'll have construction materials, and the industry of construction materials, 4 or 5 stocks within just one watch list. I'll have metals and mining, 4 or 5 stocks within just one watch list. The reason why that is because when you start understanding sectors, you start understanding that markets, typically, Wall Street doesn't like to leave cash on the table. If the market is going down, or if a sector is going down, the money is moving from this sector into another sector, and that sector is going to start going up. For example, at the beginning of 2022, we saw money coming out of technology stocks and into commodities such as oil companies, and you also saw consumer defense companies like Coca-Cola, and consumer defensive companies are something that people trust, so they put their money into them when the overall technology high risk growth sector is starting to come down. So understanding sectors and being able to recognize that this sector is starting to move. Now you have already created a watch list of 4 or 5 stocks that you like. And then if you see 5 of them moving up, and now it's time for you to go in there and make a setup, which is something that we're going to teach you. And you're going to be able to recognize, okay, out of the 4 or 5 stocks, they're all moving up. So this is looking good all over. But I like this one the most because it has the most volume, or it has the most upside potential. And that's when you're able to kind of play the market the way Wall Street does. You move your money around into the right sector. The way to recognize how to find the stocks within the sectors, that's something that we're going to teach you when we get to our scanners chapter. So the last chapter of our course is going to be the scanners chapter. We're going to teach you all about finding the stocks that are moving, how to find more stocks within that sector when you do find a stock on your scanner that's moving. It's going to be a very fun chapter when we do get to it. So that's going to be the end of chapter 4. Chapter 5, we're going to move into candlestick charts. Candlestick charts, we're going to start drifting away from the PowerPoint, and we're going to move on to charts. That way we start teaching you guys the exact way that we read charts and how to apply everything that we taught you into reading charts. And then we'll move on to technical analysis, patterns, and so on and so forth. But thank you guys for checking in. I hope to see you guys in the next video.